Good morning. My name is Jeremy Richards, and I lead the debt fundraising side, so the debt advisory team here at PKF Francis Clark. And this is our update for the November session of the FD seminars covering the debt markets in the UK. So what are we seeing high level? So we're definitely seeing slightly more cautious lending climate from funders, generally because of the external factors that are in the market. Lenders are definitely taking more time to assess applications, and preparation is key, which we'll come on to later. But it's not all doom and gloom. I think with sort of the decrease in interest rates, possibly with further decreases to go, that's encouraged a bit of stability into the market. So businesses are perhaps revisiting their growth strategies in regards using debt funding to support those. What we've also been really surprised about, and lenders as well, the feedback is, companies have done a great job of controlling costs in the current climate and refining their operations, which again are leading on to applications for debt being successful. So that's led to definite cautious optimism in the market. Despite the headwinds that are out there, lenders are definitely open for business and are supporting businesses with funding requirements. So how are we actually seeing lenders behave in the current market? So first thing to highlight, lender competition remains as strong as ever. There is good amount of funding available in the market across the high street banks, the challenger banks, and the alternative funding market with the private credit and debt funds. So, good opportunities for businesses to get their funding out there. One thing we are seeing because of the current environment is definitely lenders intensifying their assessment of debt applications, looking at a lot more at stress testing business models and looking really under sort of the skin of management teams who are ultimately going to drive that business to generate the profit to serve and the cash to service the debt. So a lot more analysis and due diligence happening on the transactions that we're seeing. Goes to say that businesses with those sort of strong fundamentals of stable recurring revenues, diversified customer basis, consistent performance, hopefully through the cycle as well, approving, for funders to make easier decisions because these are generally more resilient businesses. Not to say that if a business hasn't got all of those sort of indicators that funding is not possible. But those are certainly things that funders will look to when they're assessing applications. Another key thing as well is proactive preparation. So what we're seeing in the market is perhaps some businesses that are sticking with one lender, doing an incredible amount of work. It's taking a huge amount of time only for that lender to perhaps then say no or not quite get to the terms that were required to support the deal, which is incredibly frustrating for everybody. So our advice is, early engagement with as many funders as you possibly and sensibly can engage with, and going into those conversations with robust business plans, robust forecasts, and with all of those metrics, you will definitely see more success in fundraising. We're also seeing lenders increasingly looking at more complex structures to get deals away and to support deals. We've definitely seen an increase in the asset-based lending community in the way that they're looking at opportunities. So no longer just looking at simple items like your sort of invoice finance, funding against debtors. They're looking across all of those sort of balance sheet fixed assets. And along with that as well, putting cash flow loans alongside those facilities. So that's really helping, unleveraged or unstick transactions that we've seen here. We're also seeing lenders increasingly using equity type options, so warrants into structures where it might be viewed that it's a little bit early stage and the lender's taking a bit more risk. This is a bit more prevalent in sort of the debt funding market, whereby they'll take those warrants, a bit of equity upside in the future to support an application today. So definitely seeing structures being flexed, and perhaps a little bit more complicated than they used to be. Um, pricing still, albeit we've seen base rates coming down. There is definitely an opportunity for funders who want to win business to reduce their margins further. We're seeing those margins being reduced on both the term lending and also in arrangement fees to win good quality businesses. There's also, we've said this before, good opportunities for any projects that can demonstrate an improvement in a business's ESG credentials. We're seeing funders willing to reduce margins to win that business as well. Again, going through to sort of that complex deal structure scenario, over and above sort of the actual structure of the debt, we're also seeing funders, particularly the debt funds, being more flexible around covenants to win deals. So, perhaps not being able to compete against certain lenders on price, but certainly when it comes to setting covenant parameters on businesses that might be fast growing, sometimes that covenant headroom can win over price of a mandate as well. So we've certainly seen that being more prevalent in the market. And sort of finally, that sort of strategic funding alignment. And what do we mean by this? It's increasingly important with funders to really be able to articulate your sources and uses of funding well. Just being vague about the funding that you require and how that's going to improve the business probably doesn't cut it. Being able to articulate very well where that funding is being used, where it's going to, and one thing we would say, plan that well, because there's nothing worse than not asking for enough day one. It's almost better to ask for a little bit too much funding and be able to negotiate that back down rather than negotiate back up. So preparation, again, we've touched on this before, but we're definitely seeing, good thorough preparation by businesses is the absolute key to unlocking debt funding in the current market. As we've touched on, lenders are definitely spending more time on their diligence, looking at the business model and looking more time on with the management team. And businesses must be able to present, robust forecasts that they can articulate why certain growth metrics have been added into those application forms, and also, as we touched on just now, articulate that strategic rationale for the fundraise. All of this goes to say all of those preparations will definitely secure funding that is required for good quality businesses. Thank you very much.